Welcome everybody to the Market Board. My name is Dave and today we are looking at episode 3 of my super simplified stock series. And today we are covering the stock market as a concept, so we have to ask ourselves, just what is it? The stock market is the place where buyers and sellers trade shares or units of ownership in eligible companies. Stocks are bought and sold on stock markets and publicly traded companies. Similar to an auction, buyers name the highest price they're willing to pay, and this is known as the bid. And potential sellers name the lowest price they're willing to accept, and this is known as the ask. Trades can be placed by stockbrokers, usually on behalf of portfolio managers or individual investors like you. The difference between the best bid and the best ask is called the spread, and this is where the two sides will negotiate to sort of meet in the middle with an intermediate who executes the trade and takes the difference as their fee. Stocks are traded on an individual basis through a negotiation process between the bid and ask prices. Now, there are a few primary functions of the stock market, but for what you need to know today is that the stock market is where the general public can access stocks of publicly traded companies. It sort of functions like Craigslist, but with a few less misdemeanors, with the buyers and sellers meeting in one place to exchange things. But in the stock market, somehow it is much more complex and regulated, but even more volatile. And something to note right off the bat is that stocks actually aren't the only thing that you could buy and sell on the stock market. Other securities such as ETFs, currencies, bonds, and derivatives like options are also traded on the stock market. So something many people ask is, are there any risks to the stock market? And oh yeah, you bet there are. In my opinion, any investment into a public security is a high risk investment, and individuals need to assess their own personal risk tolerance and probably seek some professional guidance. Let's now use this opportunity to define who some of the players are in the market. So starting with retail investors, like you, they can buy or sell individual stocks through their brokerage account. When you place an order, it's sent to the exchange where the trades are executed. Next up, we have the stockbrokers, who are the registered representatives who went through training and passed a license exam. They can buy and sell securities on behalf of other investors. Additionally, in play, we have portfolio managers and investment bankers who are also participating in the market. However, much of this is going on behind the scenes, and you should be aware that there are additional personnel on board. Firstly, we have the principals, which are broker-dealer firms that own a portfolio of shares that they're willing to sell to investors, but they're looking to make a profit. Basically, it's just a markup or markdown on their end. Next up, you have the agents, who are basically middlemen, and they help connect one investor's buy or sell request to the other side of the transaction, and they often take a commission for this service. Next up, we have the stock exchange, and this is basically where your trade is taking place. They take a small fee for each transaction that happens on their exchange in return for their services, and they also charge a listing fee to the companies that offer shares on their exchange. Next up, we have the custodians, who brokerage houses often pay to electronically hold stocks for them for security reasons, I believe. And finally, we have the market makers, who have a bad rap in the media as of late, but they are individuals that quote both a buy and a sell price in a tradable asset held in their inventory, hoping to make a profit on the spread. Now, clearly, there's a lot of moving parts here, so we gotta ask, who's in charge of regulating it all? And that comes down to the U.S. Securities and Exchange Commission, known as the SEC. They have a broad mandate, being there to, quote, protect the investing public, promote fairness, and maintain efficient markets. The SEC has set rules and requirements that affect everyone participating in the stock market, and while these rules may differ based on the different stock market, they are all generally true. They require absolute transparency, meaning that you have access to proper disclosure of financial information, such as a company's audited financial reports. Confirmations. Customers trading shares on a stock exchange are entitled to the details of a transaction, including the time the trade was made, the final price you paid, and the specific commissions that you were charged. And the last terminology we'll cover here right now is what is a pattern day trader. Everyone thinks they're going to be the next Tim Sykes when they get into the market, but they soon find out that once they execute 4 or more day trades within 5 business days using the same account, they're actually required to hold 25 $25,000, 25 grand, $25,000, that's the last time I'll say it, in their margin account. So that's just something to be aware of, young gunslingers. So we asked, what are a couple of examples of a stock market? Well, the world's largest two stock markets currently are the New York Stock Exchange and the NASDAQ. Other large exchanges do exist outside the United States, though, and they include the Euronext, the Bombay Stock Exchange, TMX Group, and even Deutsche Börse. These stock markets are exchanges where companies within a specific region tend to list their shares. These regional markets can actually be accessed by traders globally, and stocks are listed on exchange can sometimes trade on other exchanges in different regions too. Guys, just to take a quick pause, if you haven't already, make sure you hit that like button and subscribe to the channel. It would mean a lot to me. But moving on, what is the history of the modern stock market? Now, my research indicates that in the United States, the first modern stock exchange was founded in Philadelphia in 1790. 2 years later, the NYSE was established as a result of the Buttonwood Agreement. Now, the thing to know is that Monday through Friday, trading begins at 9:30 a.m. local time and trading closes at 4 p.m. local time. You can, however, still participate in the after-hours market, but volume is generally lower. I hope that this video has helped answer some of your questions and made the market understandably easier. However, if you still have any questions and you want to talk to me about it, let me know down in the comments below. But just as a final reminder to everybody, I am an individual investor. I am not a financial advisor. This should not be considered your financial advice. All opinions expressed are my own and are subject to change during mood swings. My name is Dave, and this has been The Market Board.